unfortunately, the word leverage is very much misunderstood. Why? Because there are two schools of thought about leverage. Firstly, it's the marketers. So we often hear about leverage as this wonderful thing that can give us lots of riches. All you have to do is sign up to this brokerage account, and you only need $500 to get trading S&P 500 contracts. Okay, we've all heard this. We've all heard this marketing ploy of we provide 100-to-1 leverage. Okay, so that's the first sort of school of thought, which is leverage is used as a marketing ploy. The second school of thought is that leverage is bad. Don't touch leverage. It's almost a guaranteed way to sink your trading account. Leverage is evil. Okay, that's the other side of the equation. Now, most traders will come from one or the other side of the equation. In reality, though, leverage is just simply a tool, the same as a risk tool we've got, the same as the tools we have to read the charts and read the data. They are all just tools. It is as simple as that. When you use them correctly, they can solve some significant problems for you as a trader. When you use them incorrectly, of course they can cause significant damage. Now, let's be objective for a moment and look at the benefits of using leverage as well as the drawbacks. See the good, see the bad, understand both sides of the equation so that the next time you begin utilizing leverage, you have full awareness. Now, firstly, the benefits. You've got increased buying power. It goes without saying, leverage enables traders to control a larger position in the market with a smaller amount of capital. For example, if you've got 10-to-1 leverage and you have an account balance of $10,000, you can effectively, your buying power is $100,000. This increased buying power allows traders to potentially generate higher profits from smaller market moves. In other words, if you only had $10,000 and Apple stock moved 1%, the reality is you're only going to make $100. Okay, but if you can magnify that 10 times, the exact same trade, Apple still moves 1%. Now instead of making $100, you're making $1,000 for the same trade, the same number of ticks in the market. Okay, now a great example of this increased buying power. If you've ever traded a risk-off day, so a risk-off day is effectively where the equity markets sell off, the bond markets bid up. It's a very traditional day that happens quite frequently over a period of a year, but it's there's very much a directional bias in the market where stocks go down or risk markets go down and safe havens go up. Okay, so a relatively straightforward day to interpret, and you just have to kind of get your timing right in terms of the entries. Now, the reality is that if I don't have leverage on these days, okay, I'm not going to be able to take full advantage of these price biases in the market. Okay, effectively, if there was a number of different markets I'd want to trade, perhaps maybe I want to be short NASDAQ, short S&P, long gold, and long 10-year bonds. If I wanted to take all four of those positions, the reality is I'm going to have very small positions in them if I didn't have leverage. Okay, so by having leverage, I could take all four of the trades. I could put on some decent, position sizes that can ultimately allow me to profit from those price directional moves. Okay, that leads us to the second benefit, which is magnified returns. Okay, because as leverage amplifies your position, it does amplify your potential returns. Okay, like I said in that example of Apple, if the stock, the underlying, moves 1% and I've got 10-to-1 leverage on it, I'm making 10 times the profit I would if I didn't have the leverage. And this can lead to greater gains compared to trading without leverage. Okay, now the third benefit then is diversification opportunities, which means that leverage provides us flexibility to trade multiple different instruments at the same time. Okay, in other words, it allows you to take your capital, your $10,000, and allocate it across different assets. Okay, now the example I used where I had 4 different markets in a risk-off scenario, by being short equities and long bonds, effectively, maybe I go a little bit offside in the S&P, maybe my timing's a little bit off, and maybe I'm losing a little bit there because I've got the timing wrong. But at the same time, my bonds are holding bid effectively the loss is offsetted against the profit. Okay, so there's that little bit of a natural diversification that occurs when I've got leverage. If I didn't have leverage and I could only be exposed to, for example, S&P 500, the reality is that I've got nothing to offset that loss. Okay, so it does allow us to spread the risk within our portfolio and just manage things in a different way. Okay, now those are the benefits. Okay, that's the positive side of things. That's why leverage is so important for us as traders. We need increased buying power. Okay, I need to be able to take on multiple markets simultaneously. I also need to be able to make good money when there's a very high probability of, price going where I think it should. And also, I need to be able to diversify in the event that, for example, something doesn't quite go to plan, and I have got that ability to deploy, trades elsewhere to offset that risk. Okay. Now the downside. Okay, because there is a good and a bad to leverage. Now, the pitfalls of leverage is first and foremost, it is increased risk. Okay, so yes, while leverage can enhance your potential gains, it does amplify the losses as well. Okay, if the market moves against your position, the losses will be magnified as well. But think about it this way. Our job as traders is to win more than we lose. Okay, so think about it. If I did 100 trades and I win on 60 of them and lose on 40 of them, the reality is that if I deploy leverage over all of them and the same leverage, the reality is I come out on top. Okay, so that's how you have to think of leverage, and this is key to how you deploy leverage, and we'll talk a little bit about this later on, which is consistency. It has to be done consistently because, like I just said to you, if you do 100 trades, 60 of them you win, 40 of them you lose. The reality is if you're using different leverage, ultimately you're using it ineffectively. Okay, so like I said, because of leverage, we do have increased risks and our losses are magnified. So it's crucial to manage your risk effectively by using a proper risk management technique, making sure you have got stop loss orders in place, and most importantly, never overextending your leverage. Okay, making sure you never ever run the risk of a margin call. Okay, and that's the next pitfall, which is when you use leverage, a margin call is a reality. Okay, if you have no leverage, effectively to run into a margin call is quite difficult. Okay, so if you've ever utilized leverage, you've possibly come across a margin call. It's simple. Once you hit a certain threshold, the broker sends you a message, says top up your account or we will close your positions. Okay, and they're ruthless. They couldn't care less about whether your position turns out to be right in the long run or not. The moment you hit that account threshold, they no longer want to take the risk of losing their own capital. So they shut out your position automatically. Okay, and they will shut it out at the market. They don't care they don't care about whether you win or lose. What they care about is safeguarding their own capital. So margin calls is a massive drawback when ultimately using leverage. And lastly, the emotional impact. And this is not one that gets spoken about often, but realistically, one of the big pitfalls of leverage is it does weigh on our psychology. Why? Because we become so used to normal positioning. For example, let's take this trader. He's used to trading 3 lots. 90% of the time he's using a 3 lot. On the odd occasion, 10% of the time, perhaps once or twice a month, he's using a 6 lot. Okay, that's a significant change in how your psychology is ultimately going to manage things. So there's an emotional impact when it comes to using leverage, both the upside and the downside. Okay, when we're using that 6 lot, ultimately we're going to be wanting to snatch it when it's a little bit quicker. Why? Because we're not used to seeing this sort of upside. Equally, when we start to go a little bit offside, we're not used to losing that much on a single trade. And the result is our psychology hijacks our decision-making process. So it's crucially important to maintain discipline and emotional control. Okay, because impulsive decisions are guaranteed to cost you money, and impulsive decisions happen as a direct result of when you're trading emotionally. Okay, it's the monkey brain that ultimately hijacks the decision-making process. Now, let's look at, or let's summarize ultimately the benefits and the pitfalls in 5 sort of key points. Okay, the first is that leverage is a strategy. This is key and crucial and probably the most important thing to take away from this entire session. It's a strategy like any strategy. Now, a strategy's got to be predetermined. It's got to be intentional. There's got to be logic as to when you deploy that strategy, and it needs to be consistent. Okay, if you want to be good at leverage, those are the key things: intentional, consistent, making sure you're doing it time and time and time again, and making sure there's logic as to when you deploy it and why you deploy it. Okay, the second key point: timing is essential. Okay, if you want to get good at utilizing leverage, you need to recognize that timing becomes a little bit more important. You can't simply be that guy that says, oh, I'm just going to buy this level, I'm going to buy support on a chart. The reality is, when you're utilizing leverage, the upside and the downside is magnified. So timing the market becomes more essential for traders. Okay, your entry becomes more of a priority. Third key point: risk management is crucial. You cannot have trades on without a stop. You cannot just, leave trades on and hope they will magically turn out. Risk management is a priority if you are going to ever succeed at utilizing leverage. And most importantly, it needs to be a consistent application of risk management. Then, like I said, I keep saying this word: consistency. If you want to adopt the skill of leverage, you have to be consistent with it. Okay, you have to come in on day one, apply a leveraged strategy, and stick with it. Okay, what traders typically do, like this trader, they would go from a 3 lot, they would occasionally use a 6 lot, then they'd give up on it for a couple of weeks because they're too scared, they maybe lost too much, they'd go back to 3 lots, and they would try it again. And the reality is they're not applying it consistently. And all they're doing is a disservice to their account. Why? Because they are ultimately utilizing leverage inconsistently. They take the drawdowns from the additional leverage, but they never take the upside from the additional leverage. Hence that feeling of 3 steps forward, 6 steps back. Okay, and then lastly, the psychology of leverage. That's a really important thing to understand. When utilizing leverage, your psychology is going to be altered, and that's why you have to do it in a smart way. At the end of the session, I'll show you a few tricks as to how you can manage your psychology or trick your psychology in a way that you kind of become more comfortable whilst adopting the skill of leverage. Okay, so leverage is a skill. Please, please, please note that. It's not something, the marketeers tell you it's sort of a marketing gimmick, and that's true. And the doomsdayers tell you if you use leverage, you're going to wipe your account out. Leverage is nothing more than a skill. Okay, it's a strategy you deploy, and you want to deploy it at the right time, right place, and be consistent with it. Okay, so it's a skill that you adopt through a gradual, consistent process. It is as simple as that.